Welcome to Mornings with Scott. Thank you for joining me. We are live. We are. We're good to go. Let's get rolling. Hey, I had a conversation with a prospective client, some entrepreneurs that needed some help or need some help yesterday. And it reminded me of a good segment that we should be doing on this live stream in the future. So we will do that, but it's how to pitch your deal, how to write a business plan, what investors are looking for. And we reviewed this with this prospective client entrepreneur yesterday. When I say we, I mean me and my team. And I'm not going to give any details because I don't have permission to talk about it. But I will tell you this: these people had written a fabulous, fabulous business plan in the sense of pouring their heart out, getting a bunch of information, really being detailed, a lot of comments on different aspects of the business, like their competition and their marketing plan and how they're going to get orders and manufacturing it. It was all really good from that perspective. But of course, it came up with a number. This is the money we need to go forward with our plan. But what it didn't do any of was provide something that investors would be looking for to understand if the deal is financeable. There was no pitch, there was no plan in the business plan. And that is a flaw that I see often with new entrepreneurs trying to bring a bunch of information together and figure out how to go and raise capital. So, what I would urge you to do, a lot of my content on thescottsinclair.com is geared towards that. It's how to raise more money, how to be more profitable. And the very first thing that you need to do is think to yourself about what is it, consider what an investor needs out of a deal. If you had some money and I was pitching you a deal, yeah, I want to give you my why. I want to tell you how I'm, the problem that I'm trying to solve. That's all good stuff. But what you really want to know as investors, you want to know what I'm selling you. How do you get into the deal? How do you get out of the deal? What is your return on investment? So how much money do you make between in and out, getting in the deal and getting out of the deal? And how do you best make sure that your money is safe during the period that you invested it and you get your money back, right? In, out, how much do you make? How do you stay safe? That's the basics of investment, and you need to address that in your pitch. You need to address it in your 30-second pitch. You need to address it in your 3-minute pitch, and we can talk about that in the future on some of these streams. I've done it. You can go back on the YouTube channel, Martinis with Scott in the old days, the Winning Momentum podcast. We have several sections on that, several shows that tackle that topic, but we'll continue to do it further here on the live stream as we go forward. We'll create a segment for that on investing. I think that the audience would demand that. But anyways, in, out, ROI, and security. And so what does in mean? Well, if you're the investor and I'm pitching you a deal, am I trying to sell you equity? Are you buying stock? If so, what kind of stock is it? Is it common equity? Is it preferred shares? Is it some sort of convertible instrument? Or am I trying to borrow money from you? Is it debt? Maybe it's debt. If it is debt, is it secured debt? Is it unsecured debt? Where does it rank on the balance sheet? Is there interest? Is there some sort of coupon? Is there a convertible feature that goes along with that? I just noticed I didn't put my headphones on. I knew I was missing something today. I should maybe make a checklist for this new process of live streaming. Hopefully this sounds a little bit better. And so how are you getting into the deal? How am I trying to sell you into the deal? Because you have different risk and reward considerations depending on what I'm trying to sell you. And if you don't tell the investor, all you're saying is, hey, I need whatever, $1 million, and maybe you should give me 100,000 of that. I don't know what you're trying to sell me. I don't even know where to start.
right? So explain what it is you're trying to sell when you get in, and then explain how they get out. If you're selling me common shares, if I'm a 10%, 15% shareholder of your new business, when do I get my money out? Because there has to be an exit. You have to sell the business. You have to go public. You have to refi somehow, so that I can get out. And that's, you need to explain that. You need to explain when, and you're going to have to explain, at what valuation you're expecting. What is the plan to create value in this business? Otherwise, I can never calculate my ROI. If it's debt, how do I how do I know that you can when how long what is the term on the debt? And how do I know you can make enough money to pay me back or borrow from somebody else to pay me back or issue more shares to the market so you bring in some cash to pay me back, right? How do I get in? How do I get out? And then what's my return on investment? Why am I even bothering to do this? You want 100 I want $100,000 from you. I need to explain to you, hey, you can earn like the fellow we talked about yesterday, 25% guaranteed. 25% guaranteed in my hedge fund. You can earn 25% with this investment. Um, and maybe is that annual or is that over 3 years, which isn't very good? You have to remember as an investor, you're trying to figure out what is the risk reward compared to not just in isolation, but compared to other opportunities. Why am I giving you this money instead of putting it into treasuries, something that's risk free, or putting it into Tesla, which seems to go up quite a bit in recent days? And so you need to explain what the return on investment is, and therefore you need to explain growth in the value of the business and improvements in the liquidity of the business. And therefore, you need to explain a plan in numbers that's sort of month by month for 3 to 5 years, which is probably your exit period, right? You don't start a business and sell it 6 months later. It might take you 3 to 5 years to do that. and and if that's the case, you need some numbers behind that and you need some assumptions and you need to explain that all clearly. Look, nobody expects your business plan or your pitch document to work out the way that you wrote. That doesn't happen. The point of planning and projection is not to be right. The point of planning and projection is, first of all, to cause you to think about the variables and the key components, the risk factors, the the key metrics that drive your business, and then to communicate those for discussion for a stakeholder so that you can evaluate the risks, right? And so if it boils down to, we're starting this business, we're going to raise this amount of equity, I want you to participate in that, and then we're going to grow the business and it's tied to users, let's say, and the cash, everything ties to a user. So our cash flows in the future are tied to a user, because every time we get a user, it costs us a little bit of money. That's what we use the equity for. And then there's like a 2, 3 year payback on that user. And eventually this turns into a cash generating machine. And the market tells us that we can sell this business in 5 years, maybe at X dollars per user. See, there's something that makes some sense. Now, the investor may or may not like that, but at least there's a conversation that can be had. Excuse me. So, in, out, return on investment. And then what happens in between? The security, the assurances. How do I know you're good people? Um, how do I know that you can execute on this plan that I kind of like and I'm interested in? What happens if you don't? What happens if this all falls apart? We talked about this hedge fund yesterday with the 25% guarantee. That's complete bullshit. What do we do if the return doesn't work out? Well, in that case, you do nothing. It's not like anybody's going to pay you the 25% that was guaranteed. So in the situation as an entrepreneur, when you're trying to pitch a deal, remember that investors want to know what happens when they go wrong. So often in pitch decks come up with these waterfalls. Like you get the first profit, I get the next profit. We can talk about that someday. Um, they don't often offer security. So the entrepreneur debt security, a first call on the assets and the intellectual property of the business. But anyways, let's save that for another day. But just as a comment to get us started here, when you're pitching to investors, remember primarily what investors want to know at a very, very high level. How do they get in? What are you trying to sell me? How do I get my money back? How do I know that I'm safe in between giving you my money and getting me my money back? And how much can I earn realistically? So, is this a good idea for me? So that just wanted to frame that out. It was fresh on my mind from a meeting yesterday, and thescottsinclair.com, the website, the newsletter. You should go and sign up for the email if you're inclined to do such a thing. The podcasts that I do, everything that I do in content wise is geared to helping you make more money and to raise money from capital markets, which which is exactly the situation that we were talking about. Hey, I talked about this yesterday. If you're on the audio, I'm holding up a book, The Phelan Feud by Stephen Kimber, Phelan, Phelan, The Phelan Feud by Stephen P.H. Kimber. Great book. We did a whole episode on it. You can look on the YouTube channel in particular a few episodes ago. And it's a great story of family business success, excess, drama worthy of the HBO series Succession, and then and then ultimately a battle for control and a lack of succession planning and all the problems that can occur even when your business is successful. So check that out, The Phelan Feud. Check out the episode if you're so inclined. Buy the book. It's pretty good stuff. We talked yesterday. I introduced the concept for you yesterday of narrative thinking, following a storyline. Got a rough throat this morning. It's a problem when you're doing mornings with Scott and you're not done your coffee yet. Narrative thinking. I think we'll create this as a new segment. So a couple of nights ago, I was going to tell you this yesterday, but then we ran out of time. I landed in Calgary a couple of nights ago, and it was late, but it seemed hazy. It was almost dark, but the sky seemed hazy. And when you get out to the parking lot of the airport, it's smoky. You can tell it wasn't the normal extreme smoke I can't breathe that we get in British Columbia, Alberta, into the US too, Montana, the states surrounding that. And it's all from wild forest fires that are out of control. And sure enough, I think it was yesterday, I read an article in the Globe and Mail, which for you, my US audience is like the Wall Street Journal, but of Canada. And it reported that extreme heat was suffocating Western Canada. Extreme heat suffocating Western Canada with record-breaking temperatures, increasing the risk of wildfires. And there were nearly 20 new fires ignited in Alberta and British Columbia just since Monday. So in Monday, Tuesday, given the timing of the article. So in 2 days, there was 20 fires that had broken out. It is shocking. If you have never experienced this, it is shocking how far the smoke travels and how far it can impact you. My place is about half an hour north of the Montana border on a mountain. You would think I'm pretty isolated, but we've had many years, many times where you wake up and you can't see across the valley at all. There's so much smoke. You can't really breathe outside. It is horrendously unhealthy for you. And you look up on the apps to find out what's going on with a fire. It must be next door, and it turns out it's in Oregon. It's in Oregon, and it's just like the smoke's just drifting all over the continent. It's shocking. So this article goes on and says the hot and dry weather has created more fuel on the forest floors, and paired with wind is spreading wildfire more rapidly, making them harder to bring under control. Until now, the provinces have experienced a relatively quiet wildfire season despite fears from last year, etc. Yeah, that's all true. We really haven't had any fire season this year. We're already mid-July. I've lived here for several years now from the east. I moved out, and every summer, we have an expression in the town that I'm in. It says you come for the winter and stay for the summer because it's a ski town. So people come here to go skiing. The powder is outstanding. That's really why most people come here. And then if you stay over the season, as some people tend to do, you end up understanding that it's just so beautiful here. Like the mountain biking is world class where I am. World class mountain biking. The lake system, cold water, it's glacier water. It's cold, but the lake system is stunning. The mountains, the hiking is world class. There's an area not too far from me, about 20 minutes. That's all crown land. You could dirt bike, hang out forever without any issues. So it's a pretty cool area for outdoor activities of all sorts. I'm not a fisherman, but the fly fishermen come from all over the world to fish in this particular area. So you come for the winter, stay for the summer is the expression. But since I've lived here, you can't go outdoors in the summer because you can't breathe. You worry about your kids and uh, can they go out and play in whatever, basketball, soccer, go for a mountain bike ride. This it's terrible for your lungs and it's a real problem. And the smoke just becomes unbearable. And yet the government does nothing about it. They do nothing about it except for blame climate change. Remember the Mail article I just read bits to you that the extreme heat suffocating Western Canada with record-breaking temperatures is increasing the risk of wildfires. And that's exactly what the government says. Global warming, there's nothing we can do. There's going to be a bunch of wildfires. Except I happen to know really a bunch of people that work in the wildfire business. They operate, they're volunteer firefighters, they're paid firefighters as a job. They're service providers to that industry. And if you talk to them, this is not just in Canada, it's the same in US, by the way. Here's what you're going to hear. We have reduced controlled logging, right? People don't want to log sections anymore for environmental reasons and damage, erosion, disturbing animal habitations, which, by the way, fire does that too, obviously. And so we reduced controlled logging. That's a big problem. We've reduced programs that eliminate the fuel on the forest floor. Think old leaves, old branches, old everything that is highly combustible. As it dries out, it just becomes fuel for these wildfires. And instead of managing our forests, which was done back in the day, that we just leave it there. And so there's just more fuel everywhere. Wildfires are a natural part of forest life. Through the history of the world, forest fires are how forests have been rejuvenated. That's just the thing, because it gets rid of the fuel. If you want to live near a forest, you should get rid of the fuel that's on the floor by yourself. You should have some sort of program to do that. But we do not. We've reduced that. We've reduced the emphasis on fire breaks. Used to be a thing where, as we were building civilization and that was encroaching into forests, they would clear cut areas that served as a break. So if the fire's coming down the mountain and it hit an area with no fuel at all, and it couldn't cross that barrier very easily unless there was high winds blowing embers over or whatever. And so we don't have as many or any fire breaks anymore, and we have a reduced budget for equipment. It's so easy to buy a bunch of planes, mostly aerial is what you're looking for, to buy a bunch of firefighting equipment, but we don't have that much anymore. And again, this applies to both the US and Canada. So that's what the people fighting the fires will tell you, whereas what the government will tell you is the narrative that this is climate change. As the temperature warms, as the globe warms, which is part of their narrative here. And I'm not arguing one way or the other on that. I'm just saying the narrative is that as the earth warms, you're going to have more and more of these fires. And all that's happening is the government is letting itself off the hook. It's letting itself off the hook. It is not looking seriously anywhere at controlled logging, at clearing forest fuel on the floor. Emphasis, they're not looking at fire break programs and increasing budgets for firefighting equipment. And so, and why? Because it's all global warming, and what the hell can I do about it anyways? That's the narrative. And when you have narrative thinking, you don't take action. You don't do a deep dive because there's nothing you can do. That's part of the story. Once you see narrative thinking, and this is an example of it, you can't unsee it. You just see it everywhere. It is absolutely everywhere. And it's not just governments, it's in businesses, it's in trends within business, and it's in your business. It's in your life. It really is. It's and we've talked before on the channel about about how mental filters and cognitive dissonance, confirmation bias create narratives, and you only see information in your own business that feeds your narrative. And so many businesses that are not performing very well, the business owner doesn't even see that. They don't even see that because it doesn't fit within their narrative. We'll talk about that lots on this channel, but these forest fires are a real problem. And you would think the governments would break this cycle of oh, it's just global warming, that narrative, because, they've cut budgets. They're not doing the programs that we 100% know are effective. This is not risky. We know they're effective. Yet these fires contribute more carbon to the atmosphere than automobiles, if you're in the right jurisdictions, right? In Western Canada, for example, I think it's the same in the Northwest US. It would not be the same in the East because there's not as many fires. But if you're in a forest fire area, it contributes more carbon to the atmosphere, creating more global warming, if you're into that science, more carbon to the atmosphere than cars. Not just a little bit more, a lot more. In 2023, Canadian wildfires burned 7.8 million hectares of forest and released 3 billion tons of carbon dioxide into the atmosphere. That is 4 times the carbon emissions of the entire global aviation sector. The entire global aviation sector, you know how we all complain about these celebrities flying private jets and polluting the earth to their green summits. You read that in the news all the time. By the way, I don't complain about that. I think that's just a silly argument. But wildfires contribute, what did it say here? 4 times more than the entire global emissions from the aviation sector. And cars in Western Canada. So the forest fires are contributing $3 billion tons of carbon dioxide, and the cars are spitting out 153 million tons, 20 times less. Okay, so the fires are 20 times more harmful than the automobiles. Yet our government has lots of initiatives and plans to stop us from buying gas-fueled cars in favor of electric cars. I love electric cars. I'm not complaining. Okay, I disagree with the policy, but I'm not trying to bang the drum on government policy at all or here on this show. I'm just telling you that when an organization is fueled, if you forgive the pun, by a narrative, you start making stupid decisions. Forcing someone to drive electric is not dealing with the issue at hand, which is carbon going into the atmosphere. You could get 20 times more bang for your buck by clearing out some forest fire fuel. Narrative thinking, it applies in your business too. And it also in your life, if you think about this, we'll explore this idea more, obviously, but you can craft your own life narrative. you can use this as a tool to create a narrative of who you are, who your business is, who your suppliers are, who your customers are. Not only can you do it automatically. That's how your brain is built. And if you do it automatically, maybe you have a choice to change that narrative to something positive away from something negative. Narrative thinking is really, I think, one of the keys to everything about how we function in life and society and business and organizations. All right, time for our weekly segment that we call Financial Literacy for Business. Here it is, our Financial Literacy for Business segment. And today we are going to cover ROI. What is an ROI? Return on investment. Return on investment, commonly known as ROI. So what is that? A return on investment it's a performance measure used to evaluate the efficiency or profitability of an investment. Let's stick with profitability. We talked earlier on this live stream about what investors are looking for, how they get into a deal, how they get out of a deal, how much money they make in between, and how safe they are. Well, your ROI is how much money you make in between. It is simply put your return, your profit on the investment expressed as a percentage. That simple. So it's a versatile metric. It's applied to lots of different things in business and in finance. You're talking to your bank, you're talking to your investors, you're talking to, you want to make, with your customers or suppliers, you want to make capital equipment investments. Hey, I got to buy this machine. It costs $1 million, but the ROI on it is X percent. You want to have that sort of functional language literacy for business handy in your mind. So the ROI formula is pretty simple. Is you take your net profit from an investment and you divide it by the cost of your investment times 100 to make it into a percentage. So your profit divided by your cost times 100. Here's a quick breakdown. So if you, for example, invested $1,000 into, let's say, a marketing project, okay, so you're going to do $1,000 ad spend on Instagram or Facebook or what have you, and you make $200 profit from that, meaning you got your $1,000 back and you got an extra $200. Okay, so that's a $200 profit. $200 doesn't mean that you spent 1,000, invested 1,000 and only got 200. That would be a loss. No, you got 1,200 back and profited 200. Make sense? So your profit of 200 divided by your investment 1,000, you end up with 20%, and that is a ROI. It is your profit divided by your investment. 20% ROI. And the importance of it is a lot. It's really useful in decision making. You can help It helps businesses compare the profitability of multiple investments or projects, aiding in better decision making. So let's say someone related to your business comes to you and says, okay, we've got $100,000, we can invest it into marketing. We can invest it into efficiencies in operations. We can invest it into bonuses for the management team. What do we do with this money? This is called capital allocation. Well, one way to answer that question is to try to figure out the ROI on each of those options and see which one is better. What is the ROI, right? And that gives you a way to make decisions. And you could even throw in there a concept we'll talk about more in the future called the hurdle rate. And a hurdle rate is like, it's your minimum ROI before you do anything or get out of bed. I don't want to spend any money in my business on something that generates less than a 8% ROI. You've created 8% as what they call a hurdle rate. You have to hurdle over that before you actually do something and spend money on it. So it helps in decision making. It's a performance measure, of course, which is really the same as decision making, but after the fact, right? How did this decision actually work out? What was my real ROI on this? Resource allocation, we just talked about that. And I should say that, or you should know that as you talk about ROI, that ROI has lots of limitations. I'm fearful that my voice is turning into Joe Biden during the debate. I should be issuing a press release as we are talking that says I have a cold of some sort, even though I don't. Maybe I'm just aging with dementia. So you have limitations on ROI. And the limitations, number one, and I think a key one, is time. Okay, so ROI does not consider the time period over which the return is generated. A 20% ROI in year one is a 20% real return. Okay, and a 20% annualized return. If you get 20% 3 years from now, that is not the same as 20% 1 year from now. Make sense? So ROI does not deal with the time value of money, which is a significant flaw in ROI. And it doesn't deal with the risk factor associated with the investment. So if you have project A and project B, and you want to put $100,000 in your business into project A, and it generates a 15% ROI, and you've got project B, and it generates a 18% ROI in your business, you go, wow, 18 is better than 15. But what if B is way riskier and A is a slam dunk? Maybe B is not better than A. It is on an ROI basis, but the risk is different, and risk and reward are completely related, right? We've talked about that before. And so there's a limitation of ROI. It doesn't deal with the time value of money, and it doesn't deal with risk. There's other tools that can help with that. We'll talk about them some other time in our financial literacy for business series. One of them would be a net present value. That is a financial tool that really is similar to ROI mathematically, but it also incorporates the time value of money. This idea that if you get your return 2 or 3 years from now, that's different from your return today. IRR, internal rate of return, is another way to think about that. That's something that provides a discount rate at which the net present value, comes back to zero. So it's an indirect way to end up at the same thing, and we'll talk about that later. Payback periods is something that is related to this concept as well. If I have to spend $100,000 on a marketing campaign or efficiencies in operations, a new machine, or management bonuses to try and motivate certain behaviors, what is the payback period? Well, I get my $100,000 back from the operating efficiencies in 3 years, but the marketing campaign, I get my money back in 1 year. So you can think about it that way instead. Those are all different definitions. The point of the financial literacy for business segment is to give you the language, the lingo required to talk to stakeholders, investors, capital markets, your banks, right? To give you the language. So I'm just doing one at a time. And today is ROI. So that is that. And that is over my time period and all of the prepared notes that I have for today. If anybody has any comments, anything you want me to talk about, I don't think so. Thanks, everybody. See you tomorrow, 8:30 Mountain. What is that? 10:30 Eastern.